Hi everyone, welcome to 1.5 Understanding External Influences. This is the last of the Theme 1 GCSE revision videos. All of the rest are on the channel, so if you are looking for revision for Year 10 exams, Year 11 exams, final GCSEs, you'll be able to find everything you need on there. Some of this is pretty straightforward, to be honest. I think really when it comes down to it, 1.5.3 and 1.5.4 are the two that you probably want to pay a little bit more attention to. They're the ones where it gets super technical. In my opinion, probably two of the most technical topics in the course. Right, let's start with stakeholders. 1.5.1 stakeholders. Who are the stakeholders of a business? What is a stakeholder? Well, a stakeholder is any individual or group interested in the actions of a business. And there are a huge range of these. We're going to split them into two categories, internal and external. The main thing to consider here is why are they interested in the business activities? What do they want from the business? What are their priorities? And then potentially what could their conflicts be as well? So we're looking at our stakeholders. We're going to put them on two sides here. We've got internal on the left and external on the right. We've got three internal stakeholders. An internal stakeholder is a stakeholder who is involved in the day-to-day side of the business. So we've got our majority shareholders here, our owners of the business. They're the people who own the majority of the shares. They are probably going to have a lot of control over what the business does. So naturally, they're going to be involved in the day-to-day running of the business. Sometimes the majority shareholder of a company, not typically in a small company, but in a bigger company, might not be involved in the day-to-day running of the business. They might just own the company and hire someone else to run it as a CEO. That's not the case very often in small businesses. So we're going to leave them in terms of, we'll leave it as internal for now. Employees, directors and managers, well, you might argue managers and directors are employees, and that is true, but there is a distinction in terms of the decision-making power and what they actually want. So if you think about an employee, what does an employee want from a business? Well, they want to get paid. They want promotion opportunities. They want to be trained. They want motivated. They want potentially rewards and bonuses. They want job security. They want kind of those standard things that you'd expect from any employer. Directors and managers maybe want a little bit more responsibility. They might want potentially different bonus structure because they might feel like they higher up in the organization might get a share of the profits from what their business has produced through a bonus. They might want more promotion opportunities. That might be something that's more of a priority to them because they're in management already. So naturally, the key distinction here is that our stakeholders want different things. Obviously, the owners, they want the business to make a profit because if the business makes a profit, that means that they're much more likely to get a dividend. Their share price is likely to increase if it's a public limited company and they potentially can sell their share for more money if they wanted to. There are a lot more externals. I've got a full-on list here, so let's go through these. The minority shareholders, so these are owners of the business who maybe don't own very much of the company. They are not likely to be involved in the day-to-day running of the business, but they are still going to be interested in what the business does. Pressure groups, so these are groups of people, potentially companies, that aim to put pressure on a business to achieve certain goals. That could be environmental based. It could be about sort of treatment of workers. It could be environmental. It could be a whole range of different pressure groups. Customers obviously really important. They've got an interest in what the business is doing. They've got an interest in what the products are like. It's good. They've got an interest in the ethics of the company. They've got an interest in how much profit the business is making, so that they can feel like they're getting good value for money. Maybe that they're really loyal to the business. They want the business to survive so that they can continue shopping there. So customers are obviously really interested in what the business does. Suppliers, of course, as well. They want to be able to continue providing the business with supplies. They want regular orders. They want to be paid on time. They want fair treatment. There's a whole range of things that a supplier would want from the business. Government, of course, wants tax revenue from the company. They want the company to make a profit so that it can contribute to the economy, so that it can employ staff, so that those staff can pay tax. Government wants businesses to be successful. They also want them to follow laws and to treat other stakeholders fairly. We'll come back to the law side of things a little bit later on when we do legislation. Lenders, such as a bank, well, the main thing what they want is to continue to be able to lend to the business, but also that they get their money back, of course. And then the local community, they want potential. Maybe it attracts tourists to the area. Maybe it attracts other businesses to the area. It obviously creates jobs for the local community, but they will also be very careful about not wanting too much noise. They don't want potentially pollution or littering or anything like that from the company, depending on what the company is. So all of these stakeholders are affected by every decision that a business makes in both a positive and a negative way. So the key distinctions here, the key things to be aware of are be aware of what each stakeholder wants from the business, what their main objectives are, and try and pay attention to conflicts between stakeholders. So to give you an example of that, if we think about majority shareholders and employees, well, employees might want a pay rise, but the shareholders want to keep more money for their own profits. And so as a result, there can be a bit of a conflict between the two. So that's 151, stakeholders. 152, technology. Technology is a running theme throughout the entire unit and throughout the entirety of this GCSE, to be honest. And so a lot of the stuff in 152 is stuff that's already been covered. There are a few new bits as well. E-commerce has been touched on in 1.4. When we looked at the internet, we looked at location. E-commerce is selling online. Obviously, the ability to do that involves things like the internet, involves things like, devices that we can use, like tablets and PCs and laptops, and obviously now more recently, over the last sort of 10, 15 years, mobile phones have become increasingly common for e-commerce. So technology, e-commerce, probably one of the biggest and most impactful technologies in the world. Social media is a big technology, and this can be used in many, many ways, in particular when it comes to a business advertising. So, for example, you can use social media to do targeted advertising. I know for a fact that, we recently bought a new car, and so when buying the new car, and since then, to be honest, I keep getting adverts for cars. Specifically the car that we ended up buying, the type of car anyway, because clearly it's read the fact that I did a lot of Googling around that, and so it's given me adverts to try and encourage me to make a sale. So social media can be great for advertising. It can be great for kind of for anything like that, just trying to target particular customers. Digital communication doesn't just have to take place on social media. This could be through emails, through newsletters, through contact. So, for example, I'm a season ticket holder at Newcastle United, despite the fact I live in Suffolk, and the club communicate with me on a regular basis. I'll get emails before every game. I will get emails with offers for special offers in the club shop and things like that. The key thing is obviously for me, I don't go to all the games. I go to most of them, but they want to communicate with me because they only see me in the stadium every 2 weeks. One of my students who's an Ipswich season ticket holder might go to Ipswich Town every fortnight. Well, the club want to make sure they're communicating with those people throughout the year. They want to make sure they stay interested. It's been easier because the team's been doing really, really well recently, but obviously they want to make sure that they can maintain that relationship with the customer. Payment systems is a big factor as well. So obviously PayPal is probably the most significant one, but Google Pay, Apple Pay, these contactless payment systems that are becoming much more common have made it much more convenient for people to make transactions. They've made it much easier for people to buy things online. So the technology involved in those is really, really important as well. Now, the impact of this, we've got a few impacts we're going to think about. Some of these technologies are used to increase sales. That's obviously significant. Some are there to try and reduce costs, which is also significant as well. Both of those two things, if you increase your revenue or reduce your costs, should have a positive impact on your profit. And then the other big factor here is linking back to the market mix that we did in 1.4.3 and is also covered in theme 2. The impact on the market mix, for example, place in particular, but promotion too, the way that a business can make sales has been impacted by technology quite drastically. Depending on what the product is, technology might actually be a big part of the product. So you think about like a smartphone, for example, there's going to be a massive impact in terms of how technology advances might determine whether the product has a unique selling point, for example. So technology is really, really important to business. I don't think that really needs to be emphasized, but that's what I'm here for. Legislation in 153 is where we start to get a little bit complicated. You don't need to know a huge amount in terms of like actual legislation and laws. You just need to know the rights of the laws and what they kind of stand for. But if you know the laws in particular, mentioning them can make a real big impact. It can really impress an examiner if you paid attention to these things. We've got two main categories of legislation. In the A level, there are a few more. So in the A level, we look at like environmental legislation and competitive legislation. But in the GCSE, we focus mainly on consumer and employee. So consumer legislation is about the following. The quality of the product. It has to be as it's sold. So if an advert says it does something, it has to do something. If it doesn't, then you can be entitled to a refund. You can be entitled to a return. This comes from the Sale of Goods Act. So this determines the rights that a consumer has when a product doesn't meet requirements. I bought something recently that I'm going to send back just because just the sizing wasn't right. And so that's my right. Especially when you buy something online, you've got a legal right to be able to refund a product within 28 days. The other side of things is fair advertising as well, and not having false advertising that kind of misleads consumers. and that is found from the Trade Descriptions Act. So if a product is advertised in a certain way, it has to be able to meet those requirements. One really kind of joke example, really, but it is an interesting one, was when Red Bull got sued by someone because it didn't give them wings. And technically the advert says it gives you wings. So the person who sued Red Bull did win in court. Now, they didn't get a massive payout, but it did enable anyone who had proof of purchase of a can of Red Bull to be able to get their money back over, I think it might have been like a several year period. Now, obviously, they won't have paid out that much on that, I don't imagine, because I don't imagine many people would have kept proof of a receipt for a can of Red Bull. But if you had, then you'd potentially be able to get the money back. And the reason behind that was that Red Bull doesn't give you wings. Now, logic would suggest anyone buying Red Bull should know that it's not going to make you be able to fly. But technically, that's what the advert said. So what you might notice now when you see a Red Bull advert on TV is it does still say Red Bull gives you wings, but there's a lot more eyes in wings, because obviously wings with lots of eyes in, that's not an actual word. So they can't give you that because it's not an actual word. So they've been quite clever about how they've reworded it to have the same message, but obviously not get sued if they don't give you actual wings that allow you to fly. In terms of employee legislation, this is about the rights of the employee. They are split into a few categories here. Recruitment is a big one, making sure recruitment is fair. Recruitment and discrimination tie into each other really closely. Pay as well is a big factor, meaning that you have to obviously have minimum wage, so you have to be paid a certain amount for the job you do. But also that people of different genders can be paid the same and have to be paid the same for the same job. That feeds into discrimination. So discrimination can come from a variety of different areas. Obviously, if you're discriminated against at work, it's against the law. Discrimination happens within pay as well. Obviously, the whole point of the Equal Pay Act was to address inequalities between men and women in terms of being paid the same for the same job. But discrimination also takes place quite a lot in recruitment. That's where you commonly see discrimination. So this could be, for example, disability discrimination. It could be ethnicity. It could be sexuality, a whole range of different reasons someone might be discriminated against wrongly. Obviously, there's legislation to protect them from that. For example, if someone in a wheelchair applied to be a teacher at our school, if they were the best candidate for the job, then it would be on the school. We would legally be bound to make adjustments to make it reasonable for that member of staff to join the school. So that's why, I mean, obviously it goes without saying that you'd have these things anyway, but that's why every building in our school has a lift access. Obviously, that's why when we had our new building built a couple of years ago, the doorways in the new build were built to be wide enough for a wheelchair to pass through. Not just for, obviously, if we have a student in a wheelchair, but for a member of staff potentially. You would have to make adjustments. So you'd have to potentially make adjustments to, obviously it goes without saying, you try and schedule their classes to be in the bottom floor, give them one static room for the whole time. There's a whole range of reasonable adjustments you can make to make sure that an employee isn't discriminated against because of a disability or for a variety of different reasons. Health and safety is also a big factor in terms of legislation as well, making sure that employees are safe at work, making sure that customers are safe within those environments. So as long as you understand kind of, you quite often get a question like a 3-marker that says, what is an impact of legislation on a particular business? And so having an understanding of what the rights are is really, really important. The impact of these legislations can be quite significant on businesses. If there's a change in legislation, it might mean that a business has to change their processes. Obviously, there can be a cost in terms of making sure that you're meeting certain requirements. That could be a change in process. That means you have to buy new machinery. It could be that you have to change your product to meet certain legislation, which can obviously be quite costly. The other big factor is that it has a massive impact on your reputation. Now, if you follow the law, you shouldn't necessarily be clapped for that. That shouldn't be like something that's applauded. Following the law is kind of like the base expectation of society. However, not following the law will have a really negative impact on the reputation of your business. And so following the law doesn't necessarily have a positive impact, but it avoids a negative impact, which I think is really important. Now on to 1.5.4. In my opinion, 154 is probably the most complicated topic in theme 1, definitely, potentially in the A level. And it's not necessarily because the concepts are really complicated. It's just because there's a lot of terminology here that you'd probably not have heard of before. And so it can be quite specific. And it's obviously quite a lot in one topic. So it's quite a lot of heavy content in one topic. So this is probably one that requires a little bit more of a recap. Despite everything I've just said, I'm going to start with 2 terms that you probably will have heard of before. So that is income and unemployment. So income is about consumer income levels. As you can imagine, when income levels rise, people tend to spend more. But for some businesses, like for example Aldi and Lidl, they might actually see a drop in spending when incomes rise, because customers might choose to buy from more luxurious businesses. Aldi and Lidl definitely benefit, and other kind of low-cost retailers benefit when incomes drop, because people start to save money, and they might be choosing one of their ways to save money could be going to a business like that. Unemployment refers to the number of able workers who are without a job. And there's a really important distinction there, because, for example, you guys as students, you are not unemployed because you're in full-time education. And so naturally, it goes without saying that you are not able workers without a job. You're in full-time education, so you don't count as unemployed. Pensioners, babies, they don't count as unemployed either. But the number of people who want a job but can't work or can't get a job, they are the unemployed people within a society. And the impact obviously is that as unemployment is quite high, that can be a benefit for businesses, because it might make it easier to gain members of staff. You might be able to pay staff a little bit less money because there are more staff available to work and maybe more willing to work. On the other hand, when you have quite low unemployment, businesses should benefit from the fact that people have more money, so potentially can spend more money in the economy and in businesses. The next topic is inflation. So inflation, something that's been in the news quite a lot over the last few years, is about prices rising in an economy, and it is measured using CPI, the Consumer Prices Index, which is effectively a measure of a basket of goods that people typically buy, and it measures the rate at which the price of those goods changes. So if things become more expensive, inflation will rise, and so if inflation is 5%, that means that basket of goods has become 5% more expensive than it was the previous month. Now, this has a huge impact on customers, because if prices rise in an economy and your wages don't rise by the same amount, you have less money to be able to spend, which means your ability to kind of spend in an economy is diminished. It also has a huge impact on costs for a business as well, because obviously the higher inflation rises, the more it might cost a business in terms of buying materials. So inflation, the government wants, the Bank of England want inflation to be at about 2%. There's a steady rise in prices that can be amended with a rise in income. If it's higher than that, it potentially causes problems for people in terms of a cost of living crisis. Taxation, there's a few different types of tax. You just need to know what those different types of tax are. Income tax is a tax on a consumer's income. So depending on how much money an individual earns, they will pay more tax. So certainly some people, if they earn less than, like for example, my sixth form students who work part-time, they will earn less than the personal allowance, so they won't pay tax. But anyone who earns over about, well, the number varies, it changes every year usually, and I think it's about £12,700 at the moment. And people who earn over that will pay tax on every bit of income they earn above that rate. Over £50,000, it's going to be a higher tax rate, so you pay 40% of that income on tax, and obviously as you go up in pay, you pay more in tax. So that effectively the way this works is that people who earn more money contribute more towards government, and that is how government generates its income. Businesses also pay tax. They pay through corporation tax, which is just a straight percentage of their profits. There is also VAT, which is an indirect tax in that you pay it when you buy a product, and not all products are eligible for VAT. There are some sort of VAT exempt products, but for the most part, like if you buy a t-shirt, for example, a proportion of that cost of the price you've paid, will go to the government through a value added tax. And that is a tax that's a tax of a percentage of the value added that a business has added on to the product. National insurance is another tax similar to income tax because it's a proportion of income, but this one is more specifically for providing public services. So those different types of tax, they all impact on the disposable income that a consumer can spend. Interest rates are, well, there's two parts to interest rates. Interest rates are both a good thing and a bad thing depending on your situation. Interest rates are usually considered to be the cost of borrowing. So if you take out a loan, it is the money that you have to pay back in addition to the loan. The interest rate would be like the percentage that you have to pay back. But they're also a reward for saving. If you've got money in a savings account, you will then be paid interest by the bank. So the idea here is that if you are saving, you want a higher interest rate. If you are borrowing, you want a lower interest rate. So I'm currently, my wife and I are hoping to buy a new house soon. Our house is on the market. We want a lower interest rate because we're about to take out an additional part of our mortgage. So naturally, we want to pay back less on top of that as we can. If we were after this house move, we would be hoping for a reasonably high interest rate because that will make our savings generate more income. So depending on your circumstances, you either want a higher or lower interest rate. Exchange rates is the last bit of 1.5.4. This is the value of one currency in terms of another. You probably have had most familiarity with this if you've been abroad on holiday. You might have transferred pounds into a different currency. And so, for example, like £1 could be $1.30, which means for every pound, you get $1.30 of US dollars. So £10 would get you $13, £100 will get you $130, etc. Now, the key thing here is we need to understand what a business's position is in terms of imports and exports and what an import and an export is. An import is something that is bought from abroad, brought into one country. An export is something sold to abroad from one country. And if you see exchange rates anywhere, you should be writing down spiced. Spiced is the key way to remember how exchange rates work. If it is a strong pound, it means imports are cheaper, exports are dearer. So if the pound is strong, so if the pound is worth more dollars or more euros, it means when we're buying something from abroad, we get more foreign currency for each pound, which means we can buy more from abroad for the same amount, basically. What it also means, though, is that if we're exporting to another country, foreign consumers will have to transfer more of their money to get the same amount of pounds. So if you are a business that imports quite heavily, then or relies on imports quite heavily, you'll want a strong pound. If you export quite heavily, you will want a weaker pound. If you want to know what that is for weaker pound, it's just the opposite. So weaker pound, imports dearer, exports cheaper. Some people might write down like WPIDEC. I don't think that's a word, so I typically don't. I just remember it's the opposite of spiced, but some people find it useful that way. Right, the last topic here is external influences. There's not a huge amount to say on this really, because we're looking at changes in technology, legislation, and the economy. And if you've been paying attention for the last however long this video has been going on, technology was 152, legislation was 153, the economy is 154. Where does this fit in the wider picture? Well, external influences, this entire unit is effectively a part of a model called the PESTEL analysis. So PESTEL stands for political, economic, social, technological, and legal and environmental. We've looked at three of those. We've looked at technological, we've looked at legal, we've looked at economic. In the A level, you would study political and social and environmental as well. But generally speaking, when a business is thinking about the things outside of the business that impact on them, they will be thinking specifically about PESTEL analysis. And these three are probably the main ones, but for different businesses, others will be important as well. Hopefully that was useful. If you've got any questions about any of the content that we've talked about here, please do put it in the chat. And I will see you around.